So one of the problems I faced when reading price was to establish the strength of a market and when I wanted to participate in a move versus when I didn't. After a lot of study around fair value gaps, I found that not only does the repricing engine in the market spool price to areas of inefficiency, they can also be used to gauge strength and order flow of price delivery in any given market. Entering on every fair value gap without understanding the underlying narrative of the market obviously just doesn't work, right? There are many other factors that you need to consider when trying to establish which fair value gap you want to use and when. So in order to communicate with my students how we can effectively do this, I came up with the fair value gap leveling system. Let me jump onto my charts and show you how you can use this system to help you level up your price reading skills. Also, like, subscribe, and hit all that notification bell thingies if you want more videos like this. Now, I do have a separate video on fair value gaps. I'll link that in the corner somewhere. So I'm not going to specifically go over what fair value gaps are right now. But for those of you who know what fair value gaps are, we can clearly see here that we have this buy-side imbalance. So between this candle's high and this candle's low, we have price moving in one direction only, right? So this is offering us buy-side delivery. We refer to this as a buy-side imbalance, sell-side inefficiency, or a classic fair value gap. If we see a separation on either side of the middle candle where we have the imbalance, such as this little area over here where the bodies aren't overlapping, this is known as a volume imbalance. When we are marking our fair value gaps, we want to include that volume imbalance. So the fair value gap to be drawn correctly would be from this candle's high to the opening price of candle 3. So it is important to consider this when we are marking our fair value gaps, right? If we are underlyingly bullish, say from a higher time frame perspective, I anticipate that the market is going higher. A lot of the time, I won't enter just because we have dipped into a fair value gap. ICT doesn't enter on every fair value gap. A lot of the time, what he's doing is seeing how price is reacting with a fair value gap. And based on that feedback, he makes a decision on whether he wants to participate in this move or he doesn't. Now, what do I mean by that? Well, let's say, for example, we are bullish on a higher time frame. If we see a down close candle that fully closes this buy-side imbalance and the close comes in at the discount end, I would label this as level 1 bullish. Essentially, this is telling me that in order for me to continue with a bullish bias, I would have to wait for the next candle to at least close above the consequent encroachment of this buy-side imbalance. Generally, this isn't a signature that I like to see in price if I am underlyingly bullish. If I am wrong and I'm offside, and I see that this down close candle closes below the discount low of the buy-side imbalance, then this for me is no longer bullish. I would therefore need to reassess. If I change my bias at this point, then this buy-side imbalance would flip. It'd become an inverse level, and I would refer to this as an inverse fair value gap. Now, I would look for the discount low to hold as resistance and see if price would want to react from here and move lower, or travel as far as the consequent encroachment of that inverse fair value gap. Find a reaction here and then move lower. Most inverse fair value gaps that are valid, the premium end, so the upper half, ideally should be left open. And in order to find a high probability inverse fair value gap, that buy-side imbalance should occur inside of the leg that raided the buy-side liquidity pool. So above any old high or equal highs to the left. If we see price fully rebalance the buy-side imbalance, but I see the body close at or above the consequent encroachment of the fair value gap, I would deem this as level 2 bullish. This means that there is more underlying strength behind the market, and then I would anticipate the next candle to find support at the consequent encroachment or the premium high of the fair value gap. Again, I may not enter here, but it gives me feedback on the strength of the move or the subsequent move that's about to follow. If we see the fair value gap wick through, and then we see price close above the premium high of the fair value gap, like so, this is level 3 bullish. So this is stronger than level 1 and level 2. And again, I would look for the premium high of the fair value gap and or the consequent encroachment to hold as support, especially if the consequent encroachment overlaps with the midpoint of this wick or tail, right? If we see the same scenario where price closes above the premium high of the fair value gap, but we see the bottom half of that fair value gap not traded to, so we have a portion of that fair value gap left open. This is ideally what I really like to see. This would be level 4 bullish, and this is a signature in price that I often like to look for, especially if this is in line with my higher time frame narrative. Again, this is going to give me a lot of feedback. This is underlying strength behind a bullish move that's about to unfold, or is giving me feedback about the price move that's currently underway. If we see the fair value gap completely rebalanced on the third candle, like this, we refer to this as an immediate rebalance. This is level 5 bullish, and this is one of the strongest signatures in price that I look for when I'm underlyingly bullish. Generally, the subsequent move after this will be very explosive, and I'm very comfortable putting a stop below this low. If I'm on side, then it's very, very unlikely that price is going to stop me out, because the market most likely will take off in my direction, and it won't see a return back to this immediate rebalance. My favorite signature, as a bonus, is when the low of this down close candle, or it could be an up close candle, doesn't even come into consequent encroachment of that buy side imbalance. This is extremely bullish, and again is another signature that I like to look for when I'm underlyingly bullish. So what I'm doing is I'm using fair value gaps not only for entries and for draws on liquidity, I'm also using them to gauge order flow and the strength of the market based on this leveling system. If I see level 4, 5 or 6, predominantly, most of my trades will have one of those signatures in price. If I see price completely rebalance a fair value gap and or consolidate inside of a fair value gap, then I want to sit on my hands and wait for more information, or I want to reassess if my underlying bias was correct. This is very powerful, and it's really the missing piece of how you can use fair value gaps. Of course, I'm going to go over a couple of charts here, and I'll give you a few examples. So here we are on the euro dollar. This is the 1 hour time frame. Now, we have buy side liquidity resting above this swing high. You can see how we've raided that once here and then went above it one more time over here. On a side note, it's worth looking into what the dollar index did at the same time over here. We then see the market turn around and drop lower. Before this up close candle had printed, we had this large down close candle, and we had this candle's low. The next candle, we traded all the way up to that candle's low. This is an immediate rebalance. This is our level 5 bearish signature. And you can see the subsequent price move that unfolded after that immediate rebalance. It's a very powerful signature. You can see that price never came back up to this area inside of all that sell side delivery. If we look to the left here, we can see this large buy side imbalance. Note it's inside of the leg that raids the buy side liquidity to the left. After we witness the immediate rebalance, we can see this gap form here. This is a breakaway gap. And again, this is a very powerful signature in price that we want to see. We want to see these gaps remain open. A breakaway gap will confirm many things, and it will also confirm where we are inside of the dealing range. I have a lesson on gaps during my DRT mentorship, which is available for free here on this YouTube channel. But again, this kind of gap is also giving me a lot of feedback, right? It's also suggesting that price is heavy, and this comes off the back of an immediate rebalance, right? So a lot of feedback here that is suggesting we're going to have low prices. Also note the candle that creates a low of the breakaway gap. It closes below the consequent encroachment of the inverse fair value gap. Price then runs lower, closing back below the inverse fair value gap, and then finds resistance at the discount low. And then we see an expansion to the downside. Again, leaving gaps until we get to this gap over here. Notice the price action around this gap. You see how we completely rebalance, and then we spend time around here. This is going to be heavily influenced on, number one, the economic calendar, and number two, where we are inside of the range. Because of where it is in the range, we would refer to this as a measuring gap. Because from this candle's high down to this candle's low, the midpoint is where we find that measuring gap. Look at the bodies of the candles here, rejecting the equilibrium level of the dealing range, and the bodies here respecting the consequent encroachment of that measuring gap. Now, price will be held at this level inside of this consolidation, building sell-side liquidity below the market. When the time is right, we see this displacement to the downside, leaving this fair value gap. This is a level 6 bearish gap, because the next candle We don't even trade to consequent encroachment. And then you can see the subsequent move that followed afterwards. Also note, from this candle's high to this candle's low, we see price travel back into a premium. And then we see price sell off. Now we have a new dealing range. We have the buy side liquidity resting above the dealing range high and the sell side liquidity resting below this dealing range low that has cleared all the sell side liquidity to the left. So I'm just going to scrunch this to the left a little bit more so we can get a little bit more detail. Now, after price had raided these lows down here, we could see that price started to accumulate. And then we have this displacement to the upside, leaving this fair value gap in the form of this buy side imbalance. And note the bodies over here. This is level 6 bullish. Again, we're not even coming towards consequent encroachment. The reason this is a very bullish signature is because it overlaps with an inverse fair value gap on the left side of this smart money reversal. So we have an area here where it's balanced. We've had sell side through this range and then buy side back through that range. And we're seeing price here being held at support. Again, the bodies here telling the story. Price then runs higher, closing above these relative equal highs, where we have a pool of buy-side liquidity, leaving this small fair value gap. Again, we drop into the consequent encroachment, leaving the lower half open, which also overlaps with the inverse fair value gap to the left. Notice the consequent encroachment here and what the bodies are doing. So we have an overlapping of fair value gaps. And again, this is giving us feedback that price is in a hurry to reprice higher. Where would it be going to? All of this layered buy-side liquidity and the sell-side imbalance above the market. So here we have two parameters in close proximity. I explain a little bit more about this in the free training video on my website, and you can find the link below in the description. Now, let me get rid of this and let's scrub to the right a little bit over here. Notice all of this price action over here. It's all choppy and consolidating, right? Now, note where this consolidation is occurring. It's occurring inside of this inverse fair value gap. And again, knowing the economic calendar and when to expect this to form and where will save you a lot of bad trades because you'll be chopped up and down here, right? We can see that price finally closes above the fair value gap premium high over here on this candle. We retrace, find support back on that premium high. Then you can see how the up close candles here are supporting price until we finally get to this candle. Now note where this candle is. You see that measuring gap? Well, if we extend that out, again, look at the bodies here, all the way across, look at the bodies here, then look at the bodies here. We dig into it one more time over here, and then we explode higher. At what time? 8 o'clock in the morning, right? So that 8:30 macro, again, will spool price higher, aiming for those relative equal highs. Note that it leaves this buy-side imbalance, right? So this is a large fair value gap because we've had a large displacement higher. Price drops lower. Look at the bodies here of the candles. They're stopping exactly at the consequent encroachment of that buy-side imbalance. This is, again, a very strong algorithmic signature. Why? Because we already have these highs up here and they're in close proximity to the relative equal highs that we have to the left, right? At the same time, we're noticing that the bodies here are failing to close below the consequent encroachment of this buy-side imbalance. We can also see that we are failing to rebalance completely, leaving the lower portion of this fair value gap open. So we have a lot of signatures over here giving us feedback that price is likely to reprice higher. Because we have this sell side imbalance that we drag across, we now have an overlap of these fair value gaps, changing this from a level 3 to a level 4 for me. So now this gives me the green light to look for an entry. So I can hunt on a lower time frame and get in sync with the move higher. I actually traded this and posted this in my private community, but the logic was based of everything that I've just outlined over here. If you notice, just before we run the highs, we have this fair value gap. So we've had sell side delivery here, buy side delivery here, and you can see here how the bodies are respecting the consequent encroachment, and we're failing to close below it because this range is now balanced. We accumulate one more time before we really make a run for all that buy side liquidity above the highs. If you look at all of this, what do you see? This is a market maker buy model, right? Here we have the initial consolidation in the form of these equal highs. And I go into a whole lot more detail in the market maker in module 2 of my Market Maker Academy. To get a hold of the ICT Bible, which is a free ebook and a free live training webinar, head over to my website, marketmakertrading.com. And I'll see you guys soon.